Have you ever noticed markets never warn you before they become volatile? One week, everything feels calm and predictable. The next, stock prices swing wildly. News headlines are filled with fear, and even experienced investors start doubting their decisions. For most people, volatility feels like danger, but for disciplined investors, it's where the biggest opportunities are created. The difference isn't intelligence, it's their approach. The biggest mistake investors make during market declines is looking for stocks that have become cheap. A stock that has fallen from $100 to $70 may look like a bargain, but stocks usually fall for a reason: weak businesses, overvalued companies, or sectors losing momentum. Can continue falling much longer than expected. Buying simply because something is cheaper isn't investing. It's hope disguised as a strategy. Successful investors ask a different question, not what's cheap, but what's strong. Even during market sell-offs, some stocks barely decline, others recover much faster than the overall market. That usually means large institutional investors are quietly buying. These institutions leave footprints. Those footprints appear as relative strength. If the market falls 10% but a stock falls only 2, or doesn't fall at all, it's telling you demand is stronger than supply. And when markets recover, these are often the first stocks to lead. Don't just focus on individual stocks, focus on sectors. Markets move in themes. Energy may lead during supply shocks, defense during geopolitical uncertainty, technology after major corrections. Instead of owning dozens of random stocks, identify 2 or 3 strong sectors and buy the strongest companies within them. But strength alone isn't enough. Timing matters. Volatile markets are noisy. Buying too early can turn a great idea into a losing trade. Professional investors wait. They watch for periods where price moves sideways, daily swings become smaller, and trading volume dries up. This often signals that weak holders are selling, while stronger hands are accumulating. Then comes the breakout. When price moves above resistance on strong volume, that's confirmation. That's when probability shifts in your favor. Risk management becomes even more important during volatile markets. Professionals decide their maximum loss before entering any trade. If that level is reached, they exit without hesitation. Small losses are normal. Large losses usually come from refusing to accept a small one. Most investors also make the same psychological mistake. They sell winning stocks too early, but hold losing stocks hoping they'll recover. Successful investors do the opposite. Cut losers quickly, let winners continue growing. One effective method is scaling into positions. Start with a smaller investment. Only add more after the stock proves you right. This keeps emotions under control and rewards confirmation instead of prediction. Finally, never underestimate the value of cash. Holding cash isn't doing nothing, it's maintaining flexibility. It allows you to stay patient, wait for high-quality opportunities, and avoid emotional decisions. Investors who are fully invested often become reactive. Those with cash can stay selective. The biggest lesson is simple. You don't need to predict the future. You simply need to read the present clearly. Choose strength over weakness, confirmation over prediction, discipline over emotion. Because volatility doesn't create great investors, it simply reveals who they already are. And when the next opportunity arrives, will you recognize it? If you enjoyed this video, please like, subscribe, and share it with someone who wants to become a better investor. Thanks for watching, and I'll see you in the next video.